The S&P 500 moves faster today than at any point in history. Modern algorithms process global data in milliseconds, creating sudden, sharp price swings across the index. Relying on a few basic support lines and a daily moving average will leave you exposed. If you try to navigate this environment using tools built for a slower era, the market will simply leave you behind. Many traders hit a wall right here. They grasp the basics of the market, but they lack a multi-layered system to process this high-velocity information and translate it into consistent execution. Trading the S&P 500 without a comprehensive, data-driven strategy leaves you at the mercy of high-frequency algorithmic storms. To trade this environment, you need the right vehicle. A contract for difference, or CFD, lets you speculate purely on the price action of an asset. Unlike a static ETF, a CFD allows you to open positions in both directions, profiting whether the market climbs or falls. This flexibility is powered by leverage. With 20-to-1 leverage, you control a $5,400 position with just $270. But leverage multiplies your exposure in both directions. A 50-point move in your favor yields a high percentage return on that small deposit, but a 50-point move against you will drain that exact same amount from your account. Understanding how to execute a leveraged CFD trade gets you in the door. To actually survive, you have to build an adaptive strategy stack on top of those mechanical foundations. The first layer of that stack is macroeconomic data. Staring at technical charts all day is blinding if you don't track the real-world numbers moving those lines. The index reacts violently to two main reports: the Consumer Price Index, or CPI, which measures national inflation, and non-farm payrolls, or NFP, which tracks total job creation. These figures tell the market if the economy is overheating or stalling. Ultimately, all of this data feeds into the decisions made by the United States Federal Reserve. They control baseline interest rates for the economy. When the Fed takes a hawkish stance, raising rates to fight inflation, borrowing gets expensive and the S&P 500 typically drops. When they take a dovish stance, lowering rates to stimulate growth, stocks usually rally. This macroeconomic data acts as your weather forecast. If you ignore the central bank schedule, a sudden interest rate hike will tear straight through your technical setups. Once you know the economic weather, you bring that context to the charts. Your first step is to identify whether the market is locked in a strong trend or consolidating sideways. This chart shows a classic trend-following setup. Look for a golden cross, when the 50-period average crosses above the 200-period average, signaling a buy entry. When markets go flat, switch to a range-bound strategy. Sell at top resistance, buy at bottom support. Today, you don't have to spot these setups manually. Modern trading platforms use artificial intelligence to scan thousands of charts for these exact patterns, and they run backtesting software to verify how these strategies performed over years of historical data. Technical analysis and AI function as a probability engine, stacking the odds in your favor before you ever risk a dollar. Even the best technical strategy collapses under poor psychology. The two most common ways to fail are buying at the absolute top out of a fear of missing out, or revenge trading, jumping right back into the market out of anger after taking a loss. These emotional spikes push traders to over-leverage their positions to quickly make up for lost ground. When you do that, a standard calculated dip turns into a margin call that wipes out the entire account. The absolute defense against yourself is the 1% to 2% risk rule. You simply never allow a single trade to risk more than 2% of your total available capital. This diagram shows exactly how to calculate that. If you have a $10,000 account and strictly risk 1%, your maximum loss is $100. Divide that $100 by a 20-point stop loss, and your maximum position size is exactly 5 contracts. By turning risk management into a strict mathematical formula, you remove emotion from the equation entirely. That discipline is the only barrier separating a professional trader from total failure. That is the complete strategy stack. You leverage the CFD, track macroeconomic drivers, execute precise chart setups, and protect your capital with mathematical risk management. The S&P 500 rewards systematic execution and punishes guesswork. Are you ready to replace instinct with a hard, data-driven system? Open an FXNX demo account today. Practice these advanced strategies with institutional-grade technology, zero-pip spreads, and integrated AI tools to build your ultimate trading edge.